Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be learning about certain methods of depreciation, the two prominent methods that are supposed to be used when it comes to preparation of depreciation. Let's go and find out what those methods of depreciation are. To study about depreciation, we first need to understand what depreciation means. As we have already learned about it, that depreciation is the reduction in the value of the asset over the period of time. This reduction is prominent because we save that much of money so that at the end of the useful life, the same asset can be replaced with a different one and which can be used for production of goods or services as we render them while the business transactions are going on or while the business itself is going on. Now, there are certain methods of depreciation that we prominently used for preparation of depreciation or probably when charging depreciation to fixed asset comes into picture. The two prominent methods that are being used are either first straight line method or SLM method to be caused or to be known as. The second one is written down value method. So when we talk about straight line method or written down value method, we'll be understanding these methods as follows. Let's go ahead and find out these methods or these depreciations and understand how each of these depreciation methods can be used for preparation of depreciation, and we'll further evaluate them with different type of examples we'll be going through in this video. Now, the first method, I've already written down here the definition or probably the method that has been used. The first method itself is known as straight line method. Let's go ahead and find out certain details about it. This is the earliest and the easiest method that can be used for preparation of depreciation. This has been used since long time and is considered to be very easy when it comes to preparation of depreciation. Let's prepare or find the new details about it. Now here there is an assumption that we use that there is an equal usage of asset over the period of years. That means if the asset is being used for 10 years, we assume that the asset is going to be used as much as it was used in the first year itself. Hence, there is an assumption that if the first year usage is 90% of the capacity, the same capacity is being used over the year until the useful life comes to an end. This is the assumption that we have made when it comes to usage of this SLM method. Let's find out more details of this. This method is also known as fixed installment method. That means if your question paper states that you need to find out depreciation using the fixed installment method, it is nothing but the similar method that is used when we calculate depreciation via straight line method or SLM method. So it's just the name change, however the process still remains the same. Let's find few more details of this specific method. This method is used, or probably this method evaluates the further depreciation which has been maintained every year. So as we have discussed earlier that the method can be changed. However, if someone is using this method, they barely or they rarely try to change the method of depreciation. Hence, this is maintained every year. And there are certain formulas that we need to follow while preparation of this specific method. We'll prepare or probably understand the formulas that are being used or that are used when it comes to preparation of depreciation under SLM method in the next sheet. Let's go ahead and see what are those formulas and how do we use those formulas when it comes to preparation of SLM or depreciation using SLM method. Let's find that out. So as you can see, there is a certain formula which has been mentioned here. Let's go through that formula and see how this depreciation can be used when it comes to, or probably this method can be used when it comes to preparation of depreciation. Let's find that out first. Now to calculate the exact amount of depreciation, this formula will be used. That states cost of asset minus net realizable value upon usage life or the useful life of that asset. This is used to figure out what is the exact rate of depreciation, what is the amount of depreciation that can be used when it comes to preparation of depreciation or preparation of charging depreciation using SLM method. Hence, when we talk about this specific method, we'll use or we'll find out this specific method using this formula. I'll reiterate the formula again. Cost of asset minus net realizable value, that is the value which we'll receive after selling this asset, upon the cost or the useful life of that asset. Let's find out how do we calculate a rate of depreciation using SLM method. So if the rate of depreciation has to be found out, how do we use this formula? It's a very simple formula. Let's understand that part. Now, to calculate the rate of depreciation, the formula that is used here is annual depreciation amount upon acquisition cost into 100. Now, when we talk about the rate that is used, supposedly if there's X amount or X amount of depreciation that has been charged on a specific asset, now if you want to calculate what is the rate that has been charged, that means the amount that has been charged as depreciation divided by acquisition cost into 100. Now, acquisition cost includes two things. So includes original cost of the asset plus installation expenses, if any. So we know that we are installing an asset, or probably we are bringing in some plant and machinery. So that specific plant and machinery has to be installed at the site. There are certain expenses for that specific installation, and hence that is included in the acquisition cost. Hence, the total acquisition cost of the asset will not just be only the original cost, but it will also include the installation expenses. Hence, your acquisition cost will lead to installation expenses plus original cost, which will be the total of it. So, to reiterate the formulas again, to calculate the amount of depreciation on the asset, you need to use this formula. This is cost of asset minus net realizable value, that is the value that is supposed to receive when you sell off this asset, upon the total useful life of that asset. This gives you the amount of depreciation. And if you have to find out the rate of depreciation here, you need to understand this formula. That is the total acquisition cost of that asset. That will be the base of this, and this will be the amount of depreciation termed as the numerator. So the numerator side will have amount of depreciation that has been charged divided by the acquisition cost into 100. Now, acquisition cost will include two things. One, the original cost, and the installation expenses. If there are no installation expenses mentioned in the question, please do not take that. It will be only the original cost, which is equivalent to the acquisition cost. Now let's find out certain more details about SLM method. There are certain advantages that have been mentioned about Straightline method. We'll understand how Straightline method is used, what are the advantages of using this method when it comes to charging depreciation towards financial assets which have a specific value of more than 1 year of usage life. Let's find out one by one. As I've discussed earlier, that this method has been used since a long time and is the easiest method. Hence, with the first importance or the first advantage is that it is simple and easy to use. So it is very easy to use this specific method because it's a flat out depreciation when it comes to charging depreciation over assets. You calculate the amount of depreciation at the start of the year, and that same depreciation amount is deducted every year from the cost of the asset. Hence, that is the value that you will have at the end of the realizable value or probably the useful life of that asset. For example, if 10 lakhs is the cost of the asset and that asset is going to be used for 8 years with the rate of depreciation being 10%, that means every year 1 lakh is deducted from that asset value. So at the end of the 8th year, 8 lakhs will be deducted and 2 lakhs will be the net realizable value. So any transaction which gives you more than 2 lakh after selling off this asset gives you income or probably gives you gain here. However, if the asset is sold for less than 2 lakhs, that means there is a loss that you have bared here. Let's find out the next transaction, the next advantage of this. Here, assets can be depreciated up to the scrap value. That means the net realizable value. Hence, as we have discussed, that this asset or this useful thing can be further evaluated, or this method can be further evaluated to cutting down of the depreciation value until the point where the asset value becomes either zero or it reaches the scrap value or the net realizable value. Hence, this method is used whereby the companies want the asset to be depreciated to an extent where the maximum profit benefit can be taken because of the usage of depreciation. Hence, this method will be used that side. Now, this method also helps you in distributing the depreciation over the period of years. As we have discussed in the earlier example, 10 lakh cost of asset, 1 lakh being divided every year. That means one uniform amount is being divided over the usage of the asset. There is no deviation in between any of the amount. 1 lakh straight flat out being minused every year from the balance of the asset. Hence, we can say that the amount of depreciation is distributed over the usage of the life or the useful life of the specific asset. Let's go and find out what is the next option that is available. This method is useful for those assets whose useful life can be estimated and the use of the asset is consistent. Again, there is an assumption here where the use of the asset is consistent. Well, this assumption is just to make sure for this method to be used. So there are two things. This is suitable for only those assets whose useful life you can estimate and where the use of the asset is completely consistent. There is no deviation. Every hour this much use of asset will be done, or every week this much production capacity will be used of that specific asset, and that's fixed. If you have these kind of assets whereby the production capacity is fixed like this and the useful life of the asset is known or visible enough, or if you can estimate that thing, then this method is the best method for you. Now let's find out few more details of straight line method. Now we'll discuss about limitations of straight line method. What are the limitations that we have when it comes to usage of straight line method? Let's further go ahead and discuss how this limitation affects the usage of this specific method. Now, as we have discussed, that there is an assumption that we used when it comes to usage of SLM method. The first assumption being that there is an efficient usage of the work over the period of time. That means the asset will be used consistently for the same capacity over the period of time. That's a faulty assumption that we do. Right, that's correct. That's a faulty assumption that we do. Why? Is because any asset that you use, supposingly if you're driving a car, you don't drive the car at the same speed, at the same hour, or for the same usage that is done every day. Every day, the usage of the car might depend on the kind of travel that you do. It might increase, it might decrease, it might be used for more hours, it might be used for less hours. And that's the same assumption that they use when it comes to preparation of straight line method, which is a faulty assumption. Hence, this specific is the first limitation when it comes to usage of straight line method. Let's go ahead and find out the next limitations for this specific method. Now, the next assumption or the next limitation that has been mentioned here is over the period of time, the efficiency of the asset that is being used, it decreases or deviates, and hence the situation where we assume that the asset performs consistently over the period of useful life is a vague situation, or it's a vague assumption again. Hence, to give you an example, we have a car. Now the efficiency of that car will keep on decreasing the moment you keep using it every now and then. Hence, at the end of its useful life, it won't be giving out that same mileage. Let's take the example of mileage. If at all the car used to give an average of 20 kilometers per liter, do you think at the end of 10 years it will still give you 20 kilometers per liter? Absolutely correct. It will deviate, it will lower down. It will further go down to 14 kilometers. It will further go down to my 10 kilometers. So when it comes to this kind of deviation in terms of efficiency and the assumption that is being used by these people, when it comes to usage of straight line method, it's completely vague situation, and hence that's a limitation when we prepare straight line method, and it's suitable only for those assets where the estimated useful life can be judged or can be gauged further. Now let's go ahead and see what do we have when it comes to different methods of accounting or depreciation. Now the next method that we need to discuss about is the written down value method. Now, as we have in straight line method, there is a fixed depreciation, fixed amount of depreciation that is charged over the years when it comes to useful life. When it comes to written down value method, there's a little twist here. Every year, when the balance reduces of the asset, the balance that is left or that is carried forward, that is being used as a mean or the base of calculating depreciation at the fixed rate which has been mentioned in the question. For example, if you have the cost of asset as 10 lakh, that is the acquisition cost, and if there is a 10% reduction balance method depreciation or the written down value method depreciation, so at the end of first year, you'll subtract 1 lakh as 10% of 10 lakh is 1 lakh. The balance which will have, that is 9 lakh, will be carried forward in the asset account. Now for the next year, you will decrease 90,000, that is the balance of the asset 9 lakh and the depreciation 10% on it. So 10% deduction on 9 lakh will give you 90,000. The balance which will be left is 81,000. That means 8 lakh 10,000 is the amount that will be left out, and that balance will be carried out further for third year depreciation. Similarly, this will go on until the use or until the asset becomes obsolete, and at that specific time, whatever balance is left, that is the net realizable value it comes. Do remember, this specific method won't give you a net realizable value which is zero, or the cost of the asset, or probably the value of the asset won't go down to zero. It will be somewhere above zero itself. That is one more important thing, and a difference between the straight line method and the method as compared to written down value. Let's understand few more details of these things. As we mentioned here, depreciation or this method is used, or the depreciation is charged on the balance amount of the asset left every year of the asset after removing the depreciation of the first year. Hence, and this is continued until the useful life comes to the picture or comes in the picture. Hence, at the end of every year, whatever balance is left is carried forward, and the next year depreciation is calculated on that balance itself. This is one of the basic reasons why this specific method is preferred by all the people who want to use the assets to the utmost capacity and thinking that the maximum benefit of profit and loss account can be used by using depreciation. Now, the rate of depreciation can be used by using this formula. R equals to 1 minus n square root of S upon C into 100. There are certain denominations that we have mentioned here. Let's go ahead and check that. What does R mean? R mean the rate of depreciation. Now, the rate of depreciation is something that you need to find out. So that's the denomination that we have for that. N means the useful life of the asset. What is the useful life of that asset? S means the scrap value. This S means the scrap value of that specific asset, and C means the cost of asset. Hence, this is the formula that is used if you want to find out the rate of depreciation under written down value method. So when you have the written down value method, you need to use this specific method to understand what is the rate of depreciation that you have and how much rate of depreciation will be charged to calculate the amount of depreciation under written down value method. Let's understand few more details of written down value method. We have certain examples here. One example that isn't mentioned here. Let's go ahead and find out what is the cost or what is the depreciation amount that we can find out here. As mentioned, original cost of the truck is rupees 9 lakh and the scrap value that has been mentioned is rupees 50,000. Now, if you want to find out what is the rate of depreciation, what is the depreciation that can be charged, these are certain details that you need to understand. I'll mention some things here that you need to figure that out. So if you can understand, I have mentioned the amount of depreciation that can be used or that is supposed to be deducted every year from the cost of the asset if the straight line method is used. That means cost minus scrap value upon estimated life. the cost of the asset is 9 lakh, the scrap value is 50,000, which will be divided by 10. That is the estimated life, which will give you an answer of 85,000. That will further give you the details that every year a fixed amount of 85,000 is deducted from this specific asset, which will give you the balance of the end, or probably the user value or the net realizable value of that specific asset, which has been already mentioned as 50,000. So to reach the net realizable value of 85,000 or 50,000 at the end of 10 years, you need to understand which specific amount has to be deducted. That will be 85,000 flat every year. That is what you can understand when you are using straight line method. So let's figure out few more details of depreciations that has been mentioned in the next sheet. What are the advantages and disadvantages of written down value method? We have penned down certain advantages and disadvantages. Now we'll figure out how these advantages and disadvantages can be brought into questions and can be analyzed further. We'll go one by one on this. The written down value method is more realistic as compared to the straight line method, because in straight line method we have a faulty assumption as we have discussed earlier. However, in written down value method, it is as per the original balance that is left after deducting the depreciation. Hence, it includes the efficiency of the work that is being done by that specific asset as well. Now there's an equal burden of depreciation over the period of years. This is one more advantage of written down value method, whereby the balance of depreciation depends on what is the balance left of the asset, and it is not exactly that a specific amount which has been fixed gets deducted every time from the asset. Hence, it is in proportion to the balance which has been left. That's why it is mentioned equally distributed depreciation amount. Moreover, the income tax department also accepts this method for preparing depreciation as per their scrutiny. So, this is the most favored method that has been provided by the income tax department whenever they have to give out certain details of calculating depreciation according to their logic. Large portion is written off in the earlier itself. So, if you talk about depreciation under written down value method, the balance that is used is the main consistent reason or probably the main base area where the depreciation is charged. So at the start of the first year, if the balance of the asset account is 10 lakh and 10% deduction is done, that means 1 lakh is deducted. And the same thing happens every year. That means the amount of depreciation goes down every year because the balance of the asset keeps on going down. Hence, the major chunk of the depreciation is charged off in the earlier itself, and rest small things come up in the following years. So these are the advantages of written down value method. Let's understand what are the disadvantages of using this method. This is similar to SLM method. Here depreciation is calculated at the straight line fixed method. That means it is calculated at a fixed rate of interest. There is no change in the rate of interest that you can see either under the straight line method or under the written down value method. Next, find out the next difference or probably the disadvantages that we have. Here the value of asset can never be zero, as we have discussed earlier, that it depends on the value of the balance asset that is left. Hence, the value of this asset that we have can never be zero. That's the reason in case of SLM method, whereby the net realizable value is the end value of it. Here, to figure out that net realizable value, we need to figure out what is the balance that has been deducted every year from the asset account using this method. Hence, the value cannot be zero here. As I've figured out the formula for finding out what is the total value or the scrap value and asset value that can be used when it comes to calculating the rate of depreciation, it is very difficult to ascertain the actual rate of depreciation that can be charged under written down value method, because the amount of depreciation keeps on changing every year. However, in terms of rate of depreciation which has to be calculated in the straight line method, that can be easily found out because we have a constant amount of depreciation from the asset and which is fixed. Hence, it is really difficult to ascertain when it comes to written down value method. However, if the same thing has to be found out in straight line method, it is a cup of cake. Now, what are the basis of charging these depreciations under straight line method and under WDV method? We'll understand these things now. So when we talk about basis of charging this depreciation, we'll be charging the depreciation under SLM and under WDV method. Now there is a specification that we need to understand. On what basis do we charge, how do we charge, and we'll understand when we try to solve these problems further ahead. Now when we talk about any kind of basis, these are certain details that has been mentioned below. Let's go through that. Now, when it comes to straight line method, the basis of charging depreciation is on the fixed cost of the asset. That means original cost plus installation expenses of that specific asset. That is being used for ensuring that the depreciation is charged. Once the depreciation is charged on that amount, that specific depreciation that has been used will be further continued for every year until the useful life of the asset comes in, or whether the net realizable value of the asset is described there. Now the same thing if you have to understand for WDV method, when it comes to basis of depreciation or charging depreciation, this is what we'll be doing. Let's go ahead and find that out. Under WDV method, we charge depreciation on the balance which has been left at the end of every year. Hence, when we talk about charging depreciation under WDV method, we always talk about what is the balance that has been left at the end of every year after charging the first year depreciation. For example, if you have an asset worth rupees 6 lakh, and if you have divided or probably reduced it using a depreciation of 10% under WDV method, for the first year you'll have 60,000 which will be subtracted from 6 lakh. So the balance that has been left is 5,40,000. Now, when this specific balance of 5,40,000 is carried forward in the next year, you will be charging depreciation on this balance that has been charged, or this balance that has been carried forward, and not on the balance that has been already deducted or the original balance of that asset. Hence, this is known as WDV method, that is the written down value or the book value method that we talk about. So these are the two methods or the two bases under which depreciation will be charged, either on the SLM method or on the specific WDV method. We'll try to solve certain sums of different categories under this specific methods, that is straight line method and WDV method, and we'll further evaluate how to go ahead or how these specific depreciations are charged. We'll be doing a normal sum here first using the straight line method, and then using different categories of methods or different techniques when it comes to preparation of depreciation under both these methods. Let's go ahead with the straight line method first. So we have mentioned a sum here. The details are mentioned as follows. Cost of asset is rupees 10,000. Installation expense is rupees 2,000. That means the total acquisition cost of that asset is 12,000 here. Estimated life of the asset or the useful life of the asset is 10 years, which has been mentioned in the question. Rate of depreciation is 10%. You need to find out the value of the asset at the end of the fifth year. That means after reducing the fifth year depreciation, what is the balance that is left in the asset account when it comes to using straight line method depreciation. Now let's figure out what is the amount of depreciation that is charged here. So when it comes to amount of depreciation, we have a formula that we have already learned. That means cost of asset minus net realizable value upon acquisition cost or probably useful life of that asset. So to understand this specific formula, we need to find out or probably use the SLM method amount of depreciation. The formula states itself like this: cost of acquisition of asset minus net realizable value upon useful life of that year. That means this formula will give you the amount of depreciation that is supposed to be calculated on this. Let's go ahead and do that. So if you can see, we have mentioned in the answer, acquisition cost equals to original cost plus installation expenses. That gives you a total of 10,000 plus 2,000, that is equal to 12,000. So that is your acquisition cost or the cost of the asset. Now, when it comes to finding the depreciation of that specific sum or that specific asset will be as follows. Cost minus net realizable value upon the useful life of the asset. That means 12,000 minus 0, because we have no information about net realizable value. So as discussed earlier, if it is not mentioned, you will mention it as 0. 12,000 minus 0 upon the useful life or the estimated life of the asset will be 10 years. That means on an average per year, 1200 will be the deduction of depreciation from that specific asset. So every year there will be a flat deduction of 1200 rupees from that asset value. Now, as per the question, you need to find out what is the value of the asset after withdrawing or removing the 5th year's depreciation. That is something that we'll find out right now. Let's go ahead and see what is the value of the asset after the end of the 5th year. So if you can see that I have mentioned a table here, year 1, year 2, year 3, year 4 and year 5. When we talk about the cost and balance and the rate of depreciation, when it comes to Straightline method, it is this simple calculation. The cost of asset is fixed, that means 12,000. However, every year there is 1200 rupees that has been deducted. So for 5 years, the total deduction of depreciation will be 6,000. 1200 into 5 gives you a total of 6,000 here. Now this deduction will be done from the cost of asset. That means out of 12,000, 6,000 is gone at the end of 5 years. That means whatever balance has been left, that is the book value of that specific asset at the end of 5 years, 6,000. So after 6,000, that means after 5 years, the balance of that asset will be 6,000 rupees. Hence, as discussed, under Straightline method, we have asset value coming up to 0 because that is calculated evenly or distributed evenly across the number of years of the useful life. Hence, if you can see, after 5 years, if the value is 6,000, after furthermore 5 years, that is at the end of useful life, it will be 0. This is how you calculate the amount of depreciation when it comes to finding out depreciation under Straightline method. So, as per the question, the answer is 6,000. Let's go ahead for the next question. Now the next question states, find the rate of depreciation if the cost of the asset is rupees 5 lakh and the amount of depreciation every year is rupees 10,000. So what you need to figure out is how much is the rate of depreciation that we have for this specific question. Now to calculate this, we have a certain formula again for our reference. I'll write down that formula for you. Now the formula is amount of depreciation upon cost of asset into 100. This will give the rate of depreciation that has been charged under Straightline method. So if you can see, the rate of depreciation that has been charged under Straightline method is 2%. That means at the end the rate of depreciation that was calculated using this formula was 2%. How we calculated is the amount of depreciation that has been charged, that is rupees 10,000, divided by the cost of asset rupees 5 lakh multiplied by 100. If you calculate this, you will get 2% as the rate of depreciation. Hence, we have learned about how to calculate the depreciation, how to calculate the rate of depreciation under straight line method. Now, we'll take further more examples of how straight line method category sums will be coming up in your exams. So we have mentioned the question here. This is a different kind of question now. Now here we have Mr. A who bought an asset worth rupees 10 lakhs. Now this specific asset has an estimated life of 5 years. We need to figure out that and if the basis of the charging depreciation has been used as SLM method under this category, if the rate of depreciation is supposed to be found out when they have given the net realizable value is rupees 2 lakhs at the end of the useful life. What we need to calculate is the rate of depreciation. So first, let's figure out how to calculate this amount of depreciation, which will further help us to calculate the rate of depreciation on this. We'll first figure out the amount of depreciation. If you remember, the amount of depreciation formula was stated as this: cost minus scrap value of the net realizable value upon estimated life of the asset. That will give you the exact depreciation amount that has been charged under SLM method, and the same depreciation amount can be used for further evaluating the rate of depreciation. Let's go ahead and find that out. That means the amount of depreciation that is charged every year. To get the net realizable value of rupees 2 lakh, we have to make sure that rupees 1,60,000 is deducted every month from this balance. That means at one specific time every year 1,60,000 will be deducted from rupees 10 lakhs to give you the net realizable value of rupees 2 lakhs at the end of 5 years. Hence, we have calculated the amount of depreciation. Now, the next step is to use this amount of depreciation to calculate what is the rate of depreciation, which is the core question as has been mentioned in this question here. Let's figure that out. So as we have figured out that the rate of depreciation formula is as follows, which means amount of depreciation upon cost of asset into 100. That will give you what is the rate of depreciation that has been charged. Here we have the amount of depreciation as rupees 1,60,000 and the cost of asset being 10 lakhs. We'll just find out what is the rate of depreciation that has been mentioned here. Let's do that thing. That means we have flat out 16% rate of depreciation that has been charged. So we have found out two things here. First, to figure out the rate of depreciation, you need to have amount of depreciation. And if you have the cost, the net realizable value, and if the estimated life is provided to you, you can absolutely find out the amount of depreciation, and the same can be used for calculation of rate of depreciation under straight line method. So these are the category of sums that we have under straight line method. We'll further evaluate more categories of sum under this, but before that, let's go ahead and practice few more sums for written down value method, which will also give you clear idea of how to solve when it comes to preparing depreciation or charging depreciation on assets using written down value method. Let's conclude this part with using the definitions that we have used for SLM method, and let's give out a writing out for this specific sum. So in this sum we have understood how to calculate rate of depreciation using amount of depreciation on the basis of the net realizable value, the cost and the estimated life. We'll further go ahead and evaluate how a written down value method can be used to calculate depreciation. Let's go ahead and write down a question for the same. So we mentioned the question here. We'll be studying further more details on how written down value method can be used. Let's go ahead and check that thing. Now, Mrs. XYZ owns a garment company. They purchased a plant and machinery which was in the year 2015 at rupees 5 lakhs. Today it has completed 4 years. Now, these details have been already mentioned. Let's go ahead and check which further details have been mentioned here. They use WDV method as the basis of charging at the rate of 10%. So 10% was the rate of interest that was used while charging the WDV method. Estimated useful life is about 7 years here. That means this specific asset can be used for next 7 years right from the date when it was purchased in 2015. Now, they want us to calculate the balance of asset account at the end of the 4th year, that is 2019. So what we need to figure out is what is the balance that has been left, the return on value of that specific asset of the plant and machinery which was purchased in 2015 at the end of 4 years. That means at the end of 2019, what is the balance that has been left after deducting the deduction or the depreciation from it at the rate of 10%. Let's go ahead and figure out how to solve this sum. So if we can see in year 1, we will be doing certain calculations whereby original cost of the asset is 5 lakh. There is no installation cost. Hence the acquisition cost is rupees 5 lakh itself. We'll further go and study how this depreciation method can be used to find out the balance in the asset at the end of the 4th year. Now, certain points that we need to understand is rate of depreciation is 10%. Let's figure that out. So now that we have understood that how do we calculate written down value method, let's take a brief recap of year 1 what we have done here. The rate of depreciation was 10% that has been mentioned here. Now year 1 depreciation, if you have to calculate 5 lakh multiplied by 10%, that is 50,000 is the depreciation that we have found out here. Hence, balance in the end of first year under asset category will be 5 lakh minus 50,000, that is 4 lakh 50,000 balance. So this is the balance that the asset account has at the end of first year. You need to understand that this is the balance that will be carried forward in the next year. We have to calculate the same thing for next 4 years now. So year 1 has been done. We'll further go ahead for finding out the balance as compared to year 2 now. Let's do that thing. Just make sure that 4,50,000, that is the balance at the end of first year, will be carried forward in the next year. Rest, the whole process remains the same. So if you can see in year 2, we had carried forward the balance of year 1, that is 4,50,000. We further deducted 10% depreciation on it, which brought up to like 45,000. Now the balance at the end of second year is 4,05,000. So this is the balance that we have for 4,05,000 as compared to the year 1 balance. Year 1 we had 4,50,000. Now we have deducted 10% again on that balance, which gives you 4,05,000 balance at the end of second year. Now this same balance will be carried forward in the third year, and similarly we'll do it for the fourth year as well. So let's do that and figure out what is the balance that we have for third year. So if you can find out, the balance at the end of third year is 3,64,500. This is how we have calculated the balance at the end of third year. That means 4,05,000 the balance which was carried down from the second year, and the current depreciation that we have subtracted, that is 40,500, gives you a total of 3,64,500 balance at the end of third year. Now this same balance will be carried forward in the next year, and the final answer that we require at the end of 4 year, the balance in the asset account, will be justified here. Let's go ahead and do that thing. So this is the final answer for the question that was asked, that is balance at the end of fourth year. If you can see, 32,8050 is the answer that we have realized or that we have got. So at the end of fourth year, the balance that will be left in the asset account is nothing but 3,28,050 rupees. Hence, the total depreciation, if we have to calculate, that we have lost out in the last 4 years, can be done as follows. Let's check out how much depreciation has gone out and verify this answer further. So if you can figure out, there are 4-year depreciation which has been totaled here. So if you total this sum, you will get the total depreciation that has been deducted for the first 4 years, and the balance that will be left after you subtract the total depreciation from the original cost. This is the balance that will be left out of that account, and this will be the written down value of that asset after the end of 4 years. So this is how you perform when you have to calculate depreciation under the written down value method. So today what we have learned in this video is how to use straight line method, what are the different types of categories, what are the different types of method under written down value, and how to use these both methods when it comes to calculation of depreciation for any financial accounting year. So that's it for the day. Thank you for watching this video. Stay tuned to Ekeeda and keep subscribing to Ekeeda.